Don't blink.
Blink.
Don't blink. You might miss a stock market crash, a historical trade war, a 1% dip in the mortgage rates. Our attention span has been so hacked that even our financial cycles move at a pace of an Instagram reel. Our entire society is one giant YouTube short, and everybody gets to participate in the madness. Don't look away. You might miss it. All that noise. And what's the net change between mortgage rates from last April to this April, Al?
What an intro. Yeah. So last April 2023, get this. Ready for this change? Average 30-year fixed rate mortgage was around a little over 7%, 7.06%. Today, you can get a mortgage somewhere between 6.875 and 7.125%. Everything has changed, but nothing's changed.
Right. Great Pearl Jam lyric. Everything's changed. Absolutely nothing's changed. So you're telling me that if I went into a coma last April and I came out of the coma and before I even brushed my teeth, I checked the mortgage rates, I'd be like, nothing changed. And then somebody, a loan officer like, no, you don't understand. Everything's different now.
Everything's different. Things have been nuts. But the interest rate's the exact same as it was exactly 1 year ago.
Makes me think of my favorite, possibly one of my favorite quotes, but definitely one of my favorite Duncan Trussell quotes. There's some poor phoneless fool in the woods sitting next to a waterfall somewhere that doesn't even know how outraged he should be. With that, welcome to another episode of That Mortgage Show. It's April 11th. Although I don't want to talk about it, I think it'd be a mistake not to. Everybody's jumping on the bandwagon and giving their 2 cents. Very few of us are qualified. I might not be qualified. Al, not going to talk to his qualifications. Guy's got a lot of qualifications.
Not qualified.
But the last week has been historically volatile. And
historically,
we try to be a mortgage show, a real estate show, an economy show. A couple of guys spitballing here, giving our opinion. Hey, we're the voice for the voiceless. We are the folks out there that are just trying to make heads or tails of this crazy thing, and so are we.
I'll tell you what, we haven't done a show, and we've missed 2 shows, I think. We've done a show in about 2 weeks, and your one-liners are just zipping right now. So whatever you did, whatever kind of PEDs you're on for this show, keep it up.
All right, Al, I like you gassing me up. So we'll take a quick look at the stock market, and then Al, feel free to chime in at any moment. So Trump initiates his Liberation Day tariff rollout. This was no soft launch. It's completely a hard launch. Board meeting, we're going to hard launch tariffs. Reciprocal tariffs come out, and the whole world catches fire. The April 2nd to April 4th, Trump announces sweeping tariffs. The Dow Jones Industrial Average plummeted over 4,000 points in 2 days, marking one of the steepest declines in history.
I can't be like, my wife got me a call. I can't be drinking out of a straw on camera. What the hell's going on here? Should be sipping from a mug. What am I?
You should be sipping from a mug for sure.
I should definitely be. I can't be sipping out of a straw. I'm a weirdo. Sorry, go ahead.
April 2nd to April 4th. We made Wikipedia. 2025 stock market crash is now a thing in Wikipedia. So, hey, you lived through it. You should get T-shirts made. I survived the 2025 stock market crash.
Honestly, with the way the news is coming out now, if you turn on the TV or scroll through social media, you can make a shirt every single day with a different sort of sky is falling, hair's on fire, wheels coming off slogan.
On April 2nd, 2025, global stock markets began to experience downward turn as a result of tariffs and trade wars initiated by U.S. President Donald Trump. On the day the president declared Liberation Day, announcing sweeping tariffs, global stock markets, including the United States following Liberation Day, experienced panic selling. So I think it's just pretty unique that there is a Wikipedia page now, and it's etched in stone, the 2025 stock market crash. Well, it crashed on April 2nd. By April 9th, markets had rebounded sharply after Trump announced a 90-day pause on most tariffs, leading to historical single-day gains. The Dow surged 3,000 points. So stock market crash, stock market
Bring up the
surge.
Wikipedia page for the rebound.
Right? I don't think there is one.
No,
April 10th, the rally was short-lived. The Dow dropped over 1,000 points as investors reacted to a continuation of 10% baseline tariff and an increase in tariffs on Chinese goods to 145%.
I mean, it's mayhem. Obviously, as far as what it does to our business, it creates a lot of uncertainty, right? And we saw that, as we talked about with the rates. You just don't really know what's going to happen day to day, so you have loans that maybe weren't locked, and if you missed that boat, if you were on a flight, right, or if you were on vacation, you kind of missed that window, and then you hold off, and it's like, well, it's can't keep going up, it can't keep going up, it can't keep going up, and it just keeps on going up. So I think we just gotta kind of ride it out. You know what I mean? Get yourself a nice little life raft and just keep surfing over the waves until everything calms down.
Mm-hmm. Yeah.
But I think a lot of investors made kind of knee-jerk reactions. Didn't really, not necessarily based on any kind of statistics, just I guess what they thought was going to happen, and that's why we saw this sharp drop and then this sharp increase, as opposed to just maybe a little blip in the radar. So I think folks are going to just kind of you're not going to see any significant. You're definitely not going to see any significant dips right now because banks aren't going to lower interest. They certainly don't lower them as fast as they raise them. So I don't think we're going to see it shoot down.
And the Federal Reserve has no intentions of intervening. The 10-year Treasury bond, which mortgage rates follow, is similarly volatile. On April 2nd, the initial stock market reaction to reciprocal tariffs moved investors out of the stock market and into the 10-year Treasury, which is a safer asset. So typically that's investors' moves. As the stock market looks crazy, they go to bonds. Right. This caused a surge in demand for treasuries, pushing the yield down to 4.01. And I think
got down to 3, right?
Yeah, I think. Well, I know that in the intraday, we definitely saw the bond get as low as like 3.8, but right. I guess it ended trading day at 4.01 on April 4th. So that's really low. It was down from the high 4.5 down into the threes, and things were looking good, but it was short-lived. By April 7th, the 10-year, much like the volatility in the stock market, the 10-year had started rising again. By April 9th, the 10-year had climbed to 4.3. And there's a lot of speculation on why, but one speculation is that foreign countries were pulling out of the U.S. treasuries, right, just because of all the uncertainty with the tariffs and stuff. And I think I would be willing to bet that China has a giant holding of U.S. treasuries, and maybe they had a big sell-off. I read somewhere that investors were going to the German version of treasuries. So I don't really understand what all of that means, but it makes sense. There's like big clumps of people selling off U.S. treasuries, not interested in them. And that's, having a bad effect on the bond yields, and
which is climbing, which causes rates to climb. And so here we are. Now, all that being said, right, let's revert back to how we started this show. It's unchanged between where it was rates are basically unchanged between where they were last year and where they are this year. So, but once again, now that we've kind of gone through it, everything has changed, but nothing's really changed. So just to kind of bring it full circle.
Full circle. Real quick, screen share. We're going to take a look. The U.S. 10-year Treasury is at 4.563 right now, so that's a live look at it. It's dark, and it's not what you want. It's definitely not what the what the Treasury Secretary and the current administration want. Their whole thing was to drive down this treasuries, drive down rates, not just mortgage rates, but there's the United States is in debt and they have interest that they have to pay, and they want that interest to be lower, just like everybody else. And we're talking trillions. So that's part of the reason that they want these treasuries down, is so that they can take advantage of lower interest rates as well on government debt. Everything has changed, absolutely nothing's changed is a great way to put it.
Yeah. Yeah, it's wild. I mean, now if you're, for somebody that's kind of in the home buying process right now, or shopping for homes and got pre-approved during the madness, and now all of a sudden they get the phone call. It's like, hey, we were kind of at the borderline to get you pre-approved for, a $750,000 house, and now with where things are, your max is probably closer to 7, right? So that person, it might impact more than the everyday person that's, kind of deciding when they want to dip their toe in the market and start looking to buy a house, right?
Yeah.
But again, outside of those people, it's things are basically unchanged. It's just a lot of headlines and a lot of newsreels of chaos. But we'll see what happens over the next week or so, and how things hopefully calm down or steady out a little bit.
Okay. Yeah, and it's tough. You got to be level-headed, and even as we sit here and say it, it's difficult. It's a big ask.
Well, it's harder for us because we're in the business and we monitor it every day. It literally has a direct impact on our livelihood. So, but for the everyday individual, they don't really feel the pain of it. They don't really know what's going on.
Right. So I saw a headline earlier. It was actually a ticker across CNBC, and it was Larry Fink, appropriately named Larry Fink, CEO of BlackRock. He said that it seems to him that we are heading for a recession if we are not already in one. Oof. So I wanted to, people throw around recession a lot. Recession, we're in a recession, recession's happening, recession, 2008, Great Recession, blah, blah, blah. Well, what is a recession? Ooh. What even is a recession? So let's go to the trusted, all-knowing, freaking, it's like, the crystal ball of ancient times. It's here and among us. Let's rub our crystal ball and ask the all-knowing being that is ChatGPT, what is a recession?
God bless AI. Give us the short answer, ChatGPT.
A recession is when the economy slows down for a while, like really slows down. Businesses sell less stuff, people lose jobs, companies stop hiring, and overall spending drops. Like the economy catching a cold. Very casual, ChatGPT.
Very conversationally done, yeah. ChatGPT.
More official version, a recession is generally defined as a significant decline in economic activity across the economy lasting more than a few months. It is usually marked by falling GDPs. I think it's like a consecutive 2 months or 3 months or something of falling GDP. Maybe it's 6 months. Rising unemployment, lower consumer spending, and decreased industrial production. Think of it like this, says my robot friend. If the economy were a car, a recession is when it slams the brakes, not necessarily crashing, but definitely losing momentum and needing help to get going again. The National Bureau of Economic Research in the group in the U.S. that officially declares when we're in a recession, and they look at a bunch of data to make that call. All right, that was a little clunky. So I guess that the official folks that are saying, "Oh, this is it, we're in a recession," is the National Bureau of Economic Research.
Gotcha. I didn't know we had a group that officially labeled it. You know what I mean? I thought it was like, I kind of feel like we're in not like a group that's like, well, we're in a recession.
But they actually, they live like way far away on a mountaintop.
In a
compound. And what they actually do is they light a giant flame
torch.
like giant on top of the mountain, and we see it, and we're like,
no. Then the next mountain lights one, and then the next mountain lights one.
Mm-hmm.
And that's when you know recession.
And then then we see it and we're like, oh, fuck, we're in a recession.
Yeah, didn't even realize that. It's akin to Michael Scott declaring bankruptcy. I declare bankruptcy.
All right, Al.
So, yeah, old Lair Bear really not helping the news with claiming the we're in a recession. But I mean, it's not the first time that we've heard that. He's certainly not the first one that said it.
I mean, I don't think that it's possible for the world, for economies to be, because the opposite of recession is expansion. You can't expand infinitely, so recessions happen, and it's just part of the deal. So, I mean, let's get it over with. Let's make it happen. Let's get this. Let's get the show on the road. I just want to look at two things, and then we'll wrap it up. So, Alvin.
Yeah.
Although there's all this noise of a recession or housing crash or bubble or affordability crisis, there is one trend that is popping up that I think is a good trend. It's a good thing. It's we're pushing toward more of a buyer friendly market. We've talked about it with real estate agents on the show in the past, but it is seemingly here to stay. The spring home buying season is showing signs of becoming more favorable for buyers. Home prices are rising at a slower pace, and mortgage rates, while still elevated, have been easing. There's signs of mortgage rates easing. I think there's blips, signs of life. Might drop down into the sixes, pop up to the sevens, drop down to the sixes. Ooh, are we going to get to the fives back to? So there is signs of life. Hopefully, this current jump isn't here to stay very long. The housing inventory, in addition to housing prices going up at a slower pace, housing inventory has also increased by 29% nationally, leading to price reductions in many markets. So we're seeing more inventory. We're seeing a little bit slower paced growth in price. So those things kind of coupled together is giving buyers more leverage.
Yeah, and I mean, it's different depending on the market that you're in, right? You'll see some markets where some places where you don't see any houses on the market, and then I know where you are, things are booming, right?
Well, I think things are booming because Florida's just bigger. There's more people coming and going. But it depends on the market for sure. Personally, on the subject, I have been seeing in my client base or my pipeline or whatever, I have definitely been seeing seller concessions. In the last 30 days, I've closed more deals with. I looked at it this morning. There was a $16,000 seller credit, a $20,000 seller credit, and a $6,000 seller credit or concessions. With a few others that I have in process with seller concessions, people are out negotiating and they're getting seller concessions.
Now, is that because they needed it to, for a down payment or for closing costs or to get qualified? Or is that just the real estate agent just putting together a great deal and helping their client out? Or is it a combination of the two?
I think it's a little bit of both. I think that they're getting it because they can, and the market is giving that. And sometimes it's like, hey, I've got enough money, I've got this much money, and it's like, okay, well then that covers your down payment, and you're going to have to go out into the market, and you're going to have to find a seller who's willing to provide seller concessions because you simply don't have it. So there is a little bit of that, but there is also just people that are taking advantage of the buyer's market.
Right.
So we're definitely seeing it, and this is something, seller concessions is something that was not existent the last 3 years, just not existent. So to see it coming back is great. It's great. Makes for a nice process, and it helps buyers that are in need.
Yeah, especially now when affordability is at all-time highs.
Yeah,
so
save a little bit of that money.
Huge benefit.
And the boomer generation is probably a little less likely to be helping their kids and grandkids out with those things with their social security at risk and their
Pick yourself up by your bootstraps, kid.
and their freaking I don't even have boots and with their social security at risk and their
401k,
their 401ks tanking, their IRAs, but in reality, I don't even know. We can get into that on a different show. All right.
You to opt out of that one?
What do you want to
steer away
say
from
about
that
it
one?
now? What do you?
No, I've said all I wanted to say. I certainly don't want to, talk ill of any of our wonderful borrowers or sellers or viewers.
For sure.
It's unique. I think we're seeing, especially from the boomer generation, I think they're a little more reluctant to offer up any kind of concession